Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, July 24th, 2026. It is 2:34 p.m. Eastern Time, and here's what we're going to do in this video. We're going to take a look at just a quick look at the broad markets, really the index I'm focusing on the most, QQQ, and the semis as well as a subsector of tech. Obviously, QQQ being a tech-heavy index, so we'll look at the Qs, the semis, then a quick update on the game I've been playing lately, and we'll continue to play into next week. And that's making predictions on which way stocks are going to go. The big ones, not there's gazillion stocks that report every quarter. But again, I will use the earnings.com website. They rank them by importance, and again, the ones that I think are important that move the market, or I see something in the charts. Remember, I say this often, I can look at 100 charts, and 90 of them I might not have an opinion, so I'm not going to force one. 10 of those charts I might see as a clearly bullish or bearish setup or actionable long or short trade at that time. And we'll go over that in a second. Just kind of quick update on the ones that I've covered. And then next week, I'll get to those. We have a weekend coming up, so I'm not going to bother with it right now. Let's see how the week finishes. And then just remember, we're in peak earnings week now and next week. So by the end of next week, we'll have Apple, all the big ones that haven't reported. Nvidia is kind of the only outlier. For some reason it reports like a month after the rest of the Mag 8. They all the rest of the Mag 8, all 7 of them, report within that 2-week window. So all right, we'll do that next week. Let's start out with the markets, and then I'm going to follow up at the end of the video, just going over some of the Q&A, the comments that have been made, my replies. I think there's some good ones in there, and so that's how we'll wrap up the video, including the most recent comments today. Okay, starting out with, that's one I'm going to get to. Somebody had mentioned that one. QQQ. So to recap, on the daily time frame, we broke down below the symmetrical triangle pattern. Also, when I get to the Q&A, I'll make a mention on there. Somebody mentioned it's a possible bull flag on the weekly chart. At that time, we didn't have it yet. We had you could consider this a bullish pennant, that being the flagpole, the strong move up followed by a pennant. But a flag is, again, I'll get to my response there. You need to have a slight downward channel. And again, so I'll get to that response in a minute. The way I see it is the symmetrical triangle pattern, which we broke down from, clear sell signal, perfect hit of my that was T1 on the short trade based on the 60-minute chart. That was the initial and official entry. We had several other objective entry or add-on points. So breakdown, hit of key support, which further validated, as I said recently, that support level. Again, because when I had it T1 back there, it was a level that was the initial tag of that level was likely to produce a reaction, which it did. And the fact that we've had a second and now even a third reaction, we hit it again yesterday, helps to validate it. And we're starting to crack below it. Remember, on the 60-minute chart, it was initially given to you when we had this setup first as a trade setup here with a sell signal to come on a break of the wedge and then to seal the deal. I wanted to see those recent lows go, which we got. And then I gave you a first target zone, which is a zone is when I have 2 support levels in close proximity. So yesterday, as you can see on this 60-minute candle, we hit the bottom of the T1 zone. So that was the initial tag, a perfect tag at the top of the zone, first target zone. Let me center it. When I slide around, it kind of moves the annotations. Then another perfect tag, a test of those lows to help further validate it. But as I mentioned, the bounces, the buyers there's less and less vigor or engagement. And we hit that first one, boy, they came in hard and bought it, but it still fell shy of the previous highs. And that's what we have so far. We have the early makings of a near-term downtrend, lower lows and lower highs. Of course, we need to break that level. And the bottom of T1 zone is still the support level that needs to go. It was a zone because it was this gap right here. That's why I listed, hopefully you can see it. Let me try to use a different tool. Uh, this right here, you have the bottom and the top of that gap there from early May. And so you can see we hit it, little bounce, a lot less than the first time we hit it again, came into the first target zone. So we basically have effectively backfilled that gap yesterday with that, or is that today? I'm sorry, that's today's 60-minute candle. That was earlier today. I was out this morning, guys. I had a dentist appointment, 10:30 dentist appointment. I had to do a cleaning. I replied to a couple questions in the morning, and then went to that semi-annual cleaning. And that's it. So nothing's changed. I still expect a downside break. And again, as I've mentioned, the way I think it will play out, most likely when you have trading ranges, they tend to act like it's energy building like a coiled spring. That's called potential energy in science class, if you remember that term. So you have that potential energy built up, and then you need a catalyst to release it. So, the old Daisy Red Ryder BB guns that some of you had as a kid, those are spring action. You cock the little lever, and it was a spring loaded thing, and then it's the springs held back, you pull the trigger, the spring is released. That's releasing that potential energy, the pressure of the coiled spring. So I think, as I've stated before, the fact that we had such a long sideways trading range since T1 was initially hit, it wouldn't surprise me to go through T2 with very little, if any, reaction, and I still maintain T4. And if anything changes, I've already addressed that. In life, and especially in trading, have a plan A and have a plan B, and even a plan C. Plan A, you guys know what my plan A is. It hasn't waffled or changed since before we even broke down below there. It is, wait for a break of that to increase short exposure, get more aggressive. Still, there's a lot of trade ideas I'm not covering in this video. As you guys know, it's been a stock pickers market. That was a prediction I made early in the year, one of the first videos in early January. I highlighted that recently, and it has very, very much been that. Poor index fund traders or holders are going nowhere. Now that's fine because we're coming off a big, we're not far off all-time highs. So don't get me wrong on that. 401k people are happy just spinning their wheels. It's not just QQQ. You can look at the S&P 500 as well, the broad market, and you can see also that we're clearly in a multi-month trading range, having gone pretty much nowhere since really the beginning of May, been in that trading range. And obviously, it would help to see a downside break of the trading range in SPY as well. All right. I just had a price alert go off. You may have heard the little alarm, but it's one trade I think we already closed out. KHC. Just let me look at that real quick. Yeah, KHC, we already hit T4, which was my final target. I need to turn those alerts off. They're going off because we hit T3 again. I'll get to, in fact, one of the questions today was on PPC. It is a stock in this sector. I've been very selectively bullish on certain stocks in the consumer defensive sector, a lot of those being packaged food companies. So we'll get to those in just a minute. Let me just finish up the markets and the semis, and then we'll move forward. Okay, so that's it. That was plan A. Breakdown back test, rejection there. I highlight that as an objective short re-entry, add-on, new entry, and so far profitable. I'm talking about the back test of the triangle. And where do things start to change? If we break above the top of the triangle. At minimum, to me, on any existing core, short positions on the NASDAQ 100 or related stuff, that's a no-go zone, no add. At that point, we continue to go up. It'll be a scale-out zone for me, because if we pop it and it's anything but a false breakout, we're probably going to do that alternative scenario. We run at, pop the previous highs, make a marginal new yet still divergent high, as the yellow lines here show. Will be the case if it happens anytime soon. And then I can always get back in there. Again, there's no guarantee if you pop the highs, it's only going to be a marginal new high. It's what I suspect. If that happens, it is what it'll be. But who knows? We've had a lot of consolidation. Maybe it would be the catalyst for a much bigger rally. Not what I think is going to happen, but I'll certainly be a fool to say that it can't happen. And so, like in trading, react. And that's so there's, again, plan A, move back down to these 200-day moving averages, and that's 636-ish level right here, which is also T4 on the daily chart. Plan B would be where to scale out if we start punching up in here and threaten to break out to new highs. All right, let's look at the semis real quickly. SOXX being the kind of the proxy trade. On the daily, I've given you, daily targets, with the final target being down here. Although there's a good chance if and when we get to T3, I'll be reversing and going long and maybe even eliminating T4 because that's where the 200 days come in. It will also constitute a drop. Remember, the semis have already fallen, this sector, SOXX, 24% rounded off from the previous highs, all-time highs, the recent highs. And if that T3 levels hit, it's going to be a 33% wipeout. That's pretty big. So that's really kind of what I'm eyeing right now as the final target. And I think if and when we get there, it's going to coincide with that T4 level being hit on QQQ. And again, if and when we get there, I'll assess at the time and let you know whether it's a hard in, hard reversal, sit tight because something else might be going on. Remember, there's a lot of hot air in this market, FINRA margin interest bubble going on. And when that bubble pops, as they always have, I've gone over that chart. I'm not going to cue it up now. I don't want to get off task too much here. I've shared it many times. You can Google it yourself. Google a chart of FINRA margin debt and then go back as far as it'll go. And you can look at all the bear markets and bull markets, especially the ones that kind of went parabolic. And you'll see the same thing, kind of a steady climb that starts to go near vertical on the FINRA margin debt because everybody, generally speaking, of course, gets very bullish and figures, you know what, I'm making so much money on my, semiconductors and my NASDAQ 100 and all the other, the tech stuff that's going up, that why not just leverage it up and borrow more money from my broker. And, I've got 100 grand to invest. They'll let me put 400,000 into semis and therefore I'm magnifying my gains. Well, when that trade starts to go the other way, and it always has, again, just you can look at the history of that chart. There's no way to say definitively when the top is in until well after, then we can look back. Obviously, that's hindsight. But what we look for are the conditions that accompany those surges in the margin debt to know that there is that excessive, FOMO trade going on, excessive bullishness. And then we align technicals, breakdowns on key sectors, key stocks, like we've been doing, the Mag 8, the semis, and that's pretty much it. As we all know, AI is for the first time in history, I think it's I think this is unprecedented, the amount that one trade, if you will. I understand there's different subsectors, but it's all about technology and the circular trade between the big companies, the Metas and Microsofts, Alphabets of the world that are doing the massive CapEx spending. Therefore, the semis are beneficiaries. Even things like AC companies, HVAC companies I mentioned, and anything related. But again, we'll know next week. There's a lot of if there's going to be a catalyst to really send this market down, or a catalyst to keep it going, maybe break us out to the new highs, it very likely will be next week with Apple and Microsoft and the big ones giving you a little more insight. Are they going to keep the pedal to the metal on the CapEx spending, or are they going to start paring it back? And so just strap in and hold on. Just know that next week has the potential to be very volatile at minimum, up and down with those big earnings coming up, and then also to break us out of this trading range one way or the other. You guys know which way I think it's going to break. And again, we'll get I'll sharpen my pencil and we'll go over those companies next week before they report. And on a related note, on SOXX, somebody made the comment they like to use XSD. I've mentioned this many times, including in several times in the last couple of months. I very much watched this one as well, because to me this is kind of the S&P 500 whereas using an analogy, whereas SOXX is the NASDAQ 100. What I mean by that, the NASDAQ 100 is a super concentrated index, over 50% technology companies, only 100 companies total, no financials in there. So it's not very representative of the stock market or the economy. It's very representative of the tech sector and high growth companies related. Now, whereas XSD, now I'm zeroing down using that analogy on a sector here, but SOXX, as I've often shared and repeatedly in the past, has a higher concentration. The last time I checked in early January, there's only 30 holdings, and of that, you can see Nvidia back then was 8%, AMD was almost 8, Micron was over 7. The top three stocks alone made up 23%. So nearly a quarter of the entire returns of this one back then were made up of just three stocks. When I add up the top 10, it was 56% weighting. And I always get this data directly from the company's website, so I know it's accurate. And that's why I give you the as of date. So also back on January 5th, XSD is a more diversified. Instead of 30, it has 43 holdings, and you can see it's kind of much more diversified. The top holding was only 3, Micron 3.32%, PI 3.19, ON on semiconductor 2.98. So the top 3 there made up less than 10%. The top 10 made up only 29 or so percent. So now, again, why is that important? Because when you have, and the same thing happens with the NASDAQ 100, or those concentrated indexes that use, especially those that use cap weighting, it can give you a false guise of strength or weakness, guys. Trust me, I'll do the same thing when the market looks like it's about to bottom. Whenever the next big correction or bear market comes, I'll be sniffing out bottoms the same way I like to sniff out tops. One of the things I'm going to look for is our market internals improving. We know there's been just a massive deterioration over the last couple of years in market internals, market breadth. I've evidenced that by several metrics, including but not limited to the percentage of stocks trading above their or below their 200-day moving averages. And so when I look at this gives you just a little more broad-based idea of what's going on the semi sector, because it's more diversified. And it also has dropped. This one's actually dropped more. So what that's telling me is those big mega semis have kind of buoyed, at least given a little outperformance of SOXX. And this is kind of the sector as a whole, if you will, down 27% so far. And very key. That was a target. Let's see. I created that line back on May 18th, and we hit it on July 17th. So you can see it's not a hindsight support level. It's a level target that I figured would be hit back here. We've had multiple sell signals. Trendline break 1, marginal new and still divergent high. Trendline break 2. Equal or marginal new high, and then finally that's the big one that did it, the break of the trend line off the March 30th lows right there and sent us down here. So that's it. And I'll say this: if you are long-term bullish, this was support, still is support. You have you've seen a nearly 1/3 wipeout, or a quarter, I'm sorry, about a little better than a 1/4% wipeout in the value of that sector. If you think we're going higher, this is where you buy. For me, at this point in time, like I said, I suspect we're probably going to break that and go down more. There's a lot of evidence, including but not limited to. If you are new to the site, one of the most important developments that I noticed recently, other than the break of the break in the back test of that key uptrend line off the March 30th lows, was the bearish engulfing candle on the weekly chart. And this shows it really clean. If you kind of go to my weekly chart, there's that March 30th uptrend line. It broke that week right there, same as I showed you on the daily, but it also printed a bearish engulfing candle. That's a potential topping stick right there. And I say those are some of the easiest, most some of the best RR trades out there, risk reward ratio, because when you see them, what happens is they don't always play out. there's nothing 100% trading, but I always say my strategy is you take a short once you got it. It's a weekly chart. You set a stop above that candle because any violation, any move back above the top of the bearish engulfing candle negates it as a topping stick by definition if it wasn't the top. So your downside is so minimal compared downside of loss if it goes higher, if you're stopped out on that short trade versus your upside, your gain potential. And this is where I think it's going. So we've already dropped, as I mentioned, about 26% in the SEC, 25, 26. If we hit this target on my weekly chart, we're going to drop from the highs. It's going to be a total, again, depending if and when we get there. I'm just eyeballing it here, pulling out maybe somewhere that would show us hitting that in about a month, about another 3-4 weeks. And it would be a total, you can see on pop-up box on the left, about 34% drop. So that's, and that would be a good buying up. You have an uptrend line right here off the April or March 2025 lows. You have the 200-day/40-week exponential moving averages. And if we happen to overshoot it a bit, you have a nice price support level, a big major reaction high. Oh, and then last but not least, this is what I highlighted for you recently. I was waiting for, and we got it, as I told you, a bearish PPO crossover, what I call a high-level bearish PPO crossover. And I've gone over this with you, so I don't want to spend a lot of time. This is recent years without missing any. Again, if it's above the zero line, especially, pretty up there at what I call high level, when the PPO gets extended, we've had 1, 2, and we've had, that was a bullish one, 3, 4, 5, and they were followed by 19, 18. Nope, it was still, because that was the top. We kept going. So this was just a series of two of them. First one gave you a little correction, so you could really get a measure here. So 19, 45%, and 17% drop. And so far we're in there, probably a little bit about in the midpoint of the range. But again, based on my analysis, I think we can get more than that, especially considering if this bearish engulfing candle proves to be the top, or at least a significant top, then yeah, we could go down quite a bit more. And just remember, bigger picture as I roll out here long term, there is a secular bull market uptrend line that comes off the 2009 lows. So even if we hit that 34% or so near term target I'm looking at, all that is a correction in an ongoing bull market. If you're a believer that this AI thing is going to go on for quite some time, and then you buy, and that's that. But if you believe that it may be all priced in already, and that the big companies are going to start paring back some of their spending, their CapEx spending, and that cycle starts to go the other way, especially with a margin call unwind, well, that's my longer term target. And hard to say right now. If you put a gun to my head and I had to either go long for the next 2 years or short, it would be short. I'd have to tell you that. But unfortunately, nobody puts a gun to my head. I'll make that decision where I'm going to be long or short on a day-by-day, week-by-week, and month-by-month basis. Right now, all I can tell you, we're fresh off some sell signals, and I don't think it's over. And if things get real ugly, that's where we're going ultimately. And I don't even want to tell you the number because most of you probably wouldn't believe it. But let's say it would look like this. We wouldn't go there today, tomorrow, or next week. We'd probably come in with some price support right here, about 270, zigzag our way down there. It would be a total drop. I can't grab right on, or I move my things. But the percentage drop would be the same. That'd be a drop of about 60% in the semiconductor sector. And for those of you saying, Randy, that's heresy, it's crazy, the semis aren't going to go down 60%. Well, I've measured the drops in the semis before off all the divergent highs on the weekly chart. And here's 45, 49, 39, 28. That these smaller ones are coming right off what I call a bear market reset. Once you have a real bear market, you're going to get corrections when a bull market starts. You're not going to get the big ones. We can sit here and argue and debate all day long whether this bull market has years or decades left in it. Statistically, it doesn't. Statistically, it's way over its extended life when you go back and look. The average bull market used to run about 5-6 years, but the Fed got cute after the financial crisis in 2008 and didn't see inflation with their excessive money printing and zero interest rate policies. So they figured, oh, inflation's just it's like the dinosaurs. It's extinct. It died in the 70s. There's no more inflation. We can print money. They'll tear up all the textbooks that say printing money and excessive money in the system's inflationary until, well, as you know, recently inflation has come back, and we've seen levels not seen in half a century. So, and I think that's going to be a persistent theme going forward. So that's my take. So therefore, guys, keep in mind that that's what a bear market is going to do to a sector like the semis, especially after a near vertical advance like that. Um, you want to go back a little farther and just play that game, you go look at the actual sector. SOXX is just an ETF that tracks the PHLX SOX sector. It wasn't around, that ETF wasn't launched until later, but we do have the PHLX SOX sector. They were nice enough to give that to us back in the late 90s. So we're coming off here. I have it on a monthly. Yeah, mid 90s right there. And so there was the dot-com bubble, took the semis up with it, just like AI is right now. And if you bought the highs there, there's the pop-up box on the left tells you 8.5 years later, that bear market from that bubble didn't end. It ran for 8.5 years, and it wiped out about almost, that's, you can see the red there, it's nearly 90% wipeout in the semis. And even the initial drop from the crash, when you go parabolic, just like gold and silver, I showed you in the last few months, even before gold and silver peaked, that it has a pattern. Once it goes parabolic, there's 3 stages: an initial crash, then a sideways kind of dead market, with a lot of trading opportunities for a couple of years, then the final leg down before the bear market's over. And so that initial crash back then was 85%. And then there's certainly some beautiful bear market rallies to trade. This, you're looking at a parabolic chart. And mind you, I use log scaling. If I didn't use log scaling, it would look even more. I'll show you here. It's a big thing. I always try to pass along things I've learned over the years. Some charting platforms aren't going to default to log. Where is it? Oh, I have it down here. So I'll toggle it on to arithmetic scaling, and you can see it's crazy. It just goes straight up. So you want to always use log scaling on just about every time frame. I don't see any benefits to using arithmetic, which is also known as linear scaling. Log scaling, all that does, it's what it's doing for you. It's putting it's equalizing the moves in percentage terms, not dollar terms. Because when you have a $200 security, if it goes up to 400, it's doubled in price. That's a $200 price increase, but a 100% return, right? But now when you go to $1,000, if you go up 200 points, guess what? That's only a 20% return, not another 100%. And so that's what log scale kind of fixes that. I think people sometimes get hung up on absolute numbers. It's all about percentages. Okay. All right. So you know where we're at. Let's go back to that SOXX and move forward. SOXX 60-minute chart. You still have targets on the 60 down here that are roughly going to coincide with these targets I gave you on the daily, and that's that. All right. And again, remember, my expectation is that if and when it, first of all, it is if I do think it's going to happen that we'll break the recent lows that we're pretty much testing right now in QQQ. And, if there's going to be a fundamental catalyst, it's going to be next week when the big tech companies report, the remainder of the big tech companies. And I often say the technicals and the fundamentals are really interwoven. I've learned over the years, that the technicals will price in what's going to happen first. Sometimes you get the technical breakdown or move and then it starts to happen, then the news will follow. But quite often the news will coincide. For example, let's say Apple or Microsoft shits the bed next week on earnings. That could be the fundamental catalyst, but it'll also be a technical catalyst if it breaks my, the recent S1 support or T1 support level. All right, moving on. Quick recap. All right, we'll go through. I told you I would follow up because it's not just the initial reaction, it's the in the coming days, weeks. Just a quick recap on my earnings calls. Tesla, I called down. I think that call went pretty well. We closed. We were right there. That right before we reported, the stock so far has lost 17%. That's one of the biggest drops in quite a while in just a few days. So we definitely get a check mark there. Right at this 310.60 support. It's kind of meh support. It's not great support. It's just meh. It's so I wouldn't buy it here. It's certainly oversold. But look, we're just flipping now to a bearish. That PPO is starting to cross down into bear territory here after having been bullish with this little rally here. So yeah, I have no desire to try to catch that falling knife right now, even though it's at one of my support levels, potential targets. So Alphabet was the other one. Called that one down post earnings, and there it was. So far, dropped about 7%, which is a pretty big move for one of the world's largest companies. And it continues. I don't know if you can see it. I have to move my upper. That's my support level box. We continue to it hugs its 200-day moving averages, and it's holding. Remember, my BOD or lowest level support's about 314. I have it at 313.78. So if that can break down through there, then that would trigger more selling in Alphabet. And again, remember, it remains solidly, this trend indicator is solidly in bearish territory below the zero line. So it's got a lot of work to do for the bullish case. It would need to hold, defend the 200s. It would need to regain this trend line. It would need to pop. The PPO would have to, the signal line, the white line, last of the two to cross, would have to come back above the zero line. And it's certainly possible. And if it does, then it's going to increase the odds that we're going to make another marginal and still divergent high. You can see the indicators are lagging. But as of now, pretty bearish. And again, this is another check mark. ServiceNow, again, I told you I was neutral on that one. We already had a nice, beautiful trade from there to the maximum upside target. I covered this quite a bit. And if you're looking at the last couple updates, you notice I had a uptrend line here. Well, that's what we hit the other day. It looks like it drifted off that candle right there. I'll move it up just to get some precise like that. Just bothers me. So you're close enough there. A little bounce. Again, I still don't have an opinion or a position in that one. I'm just updating what I went over with you guys on earnings. So I didn't make a call. So that's so far 2 for 2 with Tesla and Alphabet. IBM I called up. We were long the stock. So obviously if I didn't have the confidence, I would have closed the trade out early before earnings. And twice I've suspended the stops, both the day before earnings and then yesterday, because as I said, we kissed this support. And there's an example of how I always have a trading plan, but I'm also flexible. I'm not super rigid. If I see something that convinces me to modify my trading plan, like this one, I will. So as I told you yesterday, going to give it a little more room and then reinstate the stop, change the stop to below that low. And at this point, you could start trailing it up. If you did that, instead of getting stopped out for a loss, let me turn off all the lines. So instead of getting stopped out for a loss, the stock has popped up 7% off that tag of support yesterday. And still by the skin of its teeth, clinging to that positive divergence. T1, I added, I don't know where it went. I gave you a potential second target yesterday. Oh, you know what I might have done? Sometimes I pen this stuff in with the screen grab software, potential T2. So if the market holds up, QQQ and all that, I will consider making that an official target. Alrighty, so and remember, when I call these, it's not the initial reaction in the pre or post market. It's the following reaction, the coming days, weeks. So far, I'm not going to call that a big win, but we are up from where before where they reported. We're trading slightly positive, so certainly not a wrong call yet. Let's see, time will tell. Texas Instruments still dancing on that report. I called that one down from earnings, and it is down from earnings. It's down, not big, but it's at that 274.89 support. The only one that was a miss was URI, because it was at Sport at Pop. But then yesterday I told you was probably the end of the run, that post earnings pop. Put in another divergent high, just waiting for a bearish crossover on the PPO. I don't have any sell signals, so I'm just going to leave this one alone for now. But I think it's at it, it may have peaked yesterday. If not, it's probably not far from putting in a top. And then I already went over the other ones. Let's not get into all those. I think they're where they're at. Oh no, the three that reported the next day were Intel. I called Intel down. Certainly did go down. It's not much, but it's down from where it was. Yeah, actually, it's down 7.5% today. This is the day we closed there. They reported after the close. So yeah, that's it. That's certainly a win, down 7%, 7.5%. I think that's enough to say another successful call. Fix, called that one down. Again, Comfort System USA is an HVAC company, a beneficiary of the AI trade due to the data centers needing a lot of cooling systems installed, and called it down because it had already triggered a sell signal, and it's down 7% today following yesterday's earnings release after the close. So that's another win so far. And then Newmont, called it up because I'm bullish on the miners. It reported after the close, and we're down 2%, which on the miners, they're so volatile. I'm not trying to skew this, but that's basically a flat day for me. I mean, we're about where we closed the day before they reported. It's down slightly, and I still like the stock and the miners right now for near term, their long trade ideas. And again, this is a big one in the sector, so I'll continue to revisit them next week. And again, I'm going to go over the big stocks that are going to report next week. We'll start doing that video next week, right before they report. Okay, now let's get to the Q&A. I'm going to take it back. If I missed anything, there were a lot here, but I believe I already covered all these questions. If I didn't, or if you posted a question for me, chart request, and I missed it, because I usually only go back a few posts, just repost it under one of the most recent posts, and I'll try to get to that. This one, I might have covered some of these already in the recent videos. Somebody asked about McDonald's. Yes, I know I did cover that already, and I give you a chart. You can also just come in here and click it and read these comments yourself. Some feedback on the videos. Somebody talking about asking for oil. Yes, I'll give you my update on crude oil there. Oh no, somebody was looking forward to that video. Someone just made a comment, didn't ask me about oil, just said something about rates and crude oil. Somebody asked me about BMNR. Okay, so I'd like to read my reply on this one. So, and you can read this as well. I'm going to glance through it. Here's my daily chart of BMNR. This was yesterday. I replied with potential price targets. In a nutshell, guys, if you recall, just recently I highlighted both Bitcoin and strategy as an objective but aggressive short entry. I called it aggressive because we had just broken out of the bullish falling wedge pattern. The downtrend line was right here. I gave it to you. I said, you know what? I think it's going to fail. I think this is an objective short, albeit aggressive. And if you took that short the other day, again, I'm just measuring the high. It was very close. It was that day, I believe. We'll pull it up here in a second. 721 Tuesday. Then you've made, and again, MSTR is my preferred proxy. It's dropped as much as 14% in those 3 days. And to find that, you just go in to find any stock. You can just go to resources here, go down to the bottom and type it in MSTR. And then you get all the last recent updates. So this was the last update on it here. And then you're getting the video recap. So if you scroll down, you're going to get it right here, timestamp. And I said, despite the recent short cover rallying and bullish divergences, strategy is back testing its major reaction low. In the intermediate term remains, the technical outlook remains bearish. And I highlighted as an aggressive short entry or add-on at current backtest resistance with tight stops. And that was, again, the 21st, like I told you. So That's swing trading. Get in, get out, hit and run, take your objective entries. And remember, I still have longer term targets. And as I've stated, uh, it's just kind of an incremental type. The way my mind's eye sees this working out, it's the vicious cycle, the unwind. With strategy. Again, talking about leverage, that's what they do. It's a Bitcoin treasury fund. They migrated from a tech company to a Bitcoin treasury company, and they use a leverage strategy. And then they just decided to even juice it up more with their new preferred shares recently. And we all know that's been a mess. And so, um, I think if we start to go down here, if this breakout fails, as I suspect, again, I've maintained these targets all along, the further we drop, the more it's going to be a vicious unwind where strategy will then likely be forced to sell Bitcoin. And when they sell Bitcoin, which they've already started to do, it's been a psychological blow because, as you guys know, Saylor was iron fist. Never, never sell Bitcoin. We'll never sell. And then started backpedaling on that. And then recently started selling and then trying to throw in some BS caveat. Oh, yeah, well, we're only selling to, to finance or for liquidity needs for our new preferred shares. It sounds to me it's a freaking shell game, if you ask me. And the whole crypto is to begin with, in my opinion. Anyways, it's just bits and bytes, no intrinsic value. All right, so that's it. Anywho, just watch the recent lows. And again, for strategy to implode, you're going to need Bitcoin to go down. And Bitcoin, like I said, it's not an all-in moment. You did put in a big divergent low. That's where I highlighted the other day as a short on the 21st, right there. We're right off the highs, and it's already dropped. Here, we got to zoom in a little bit. Again, nothing much, but it's been a almost 6% drop. But remember, we've gotten over twice that in strategy. That's my preferred proxy. And so I will recognize and have been the positive divergence, the bullish falling wedge, the breakout. But I'm also highlighting that it's this trend indicator, the PPO signal line. When it's below, it's bearish. It's been this whole period there. It said sell, you're in a bear trend. We had a brief pop there. We even traded it. We went long Bitcoin back then and strategy. We caught that little bounce part of it. Then we reshorted here, and this crossed back down. And so if we get a rejection here, just like we did right there, it keeps the bearish trend intact. So that's one reason that I am going against one of my favorite patterns out there, which is the bullish falling wedge pattern, because in bear markets, you're going to get bullish chart patterns, just like you get bearish chart patterns form in bull markets, but they really don't play out they usually don't play out for their full measured move or a top. They just pull, best give you a little correction. And so far, that's what we had. That's a corrective wave. That's a corrective bounce. Um, so that's it. So you guys know my thoughts there. But again, I think we'll really get the party started if Bitcoin starts to break the recent lows. Even better to see these divergences get burned out. What does that mean? See this reaction low here? We need to drop below that. So if the indicators go like this and that divergence gets taken out, we drop there, take out support, boom, should be lights out. And I think that's going to have, guys, it's a big if. It's a lot of conditions need to happen, but I think it'll have larger ripple effects throughout the stock market because it's known fact. It's not just the retail. It initially was this little obscure niche group of anti fiat currency, the anti-system. Bitcoin's a way to put money in and get away from the rig system. But as I've mentioned, that ship is long since sailed. That was Bitcoin of yesteryear. When Wall Street got their dirty, grubby, greedy hands all over it, first by legitimizing it with futures, and then the spot ETFs, and now it's everywhere. It's no longer what it used to be, and so anyway, so that's why, I'm predicting the potential near demise, wipeout of Bitcoin, and it would just be a huge trade. And then on that too, this kind of goes. We have one subscriber constantly asking about tends to prefer leverage ETFs. If you recall, I did a video detailed when to use and when not to use leverage ETFs. I used MSTZ as an example. In fact, I went over there's three strategy inverse leverage ETFs. And I encourage you to check that one out. Again, let's go to resources here and go to MSTZ, and I went over when to use and when not to use those. So if you're new to the site, check this one out. You can find it the way I just did by entering that ticker tag for MSTZ. It's going to sort, fewer trades. And that's it. So the takeaway is when you're in a grindy market, you're not that certain. In other words, only use those leverage ETFs, especially, and let me repeat this, especially 3-time leverage ETFs, and especially with a volatile underlying instrument. What I mean by that, you can do a 3-time leveraged long short S&P 500 index fund. They do exist. The decay isn't going to be that bad, even when the market chops around a little bit. You're going to have it due to the math, but the decay is outright vicious in a very volatile underlying, such as Bitcoin strategy or SOXX, the semis. So if you're in SOXS, which I know at least one person here has a lot of it, remember the semis, and I made a.
This is Randy Finney with Right Side of the Chart, and
okay, it was right here with this one, and you can see the chart. So, the time to use it was when your degree of confidence is really high. We've been in a trading range, which I've been highlighting on a near daily basis now in QQQ. The semis have been in a downtrend, but it's kind of an orderly downtrend. In fact, I posted an updated chart of SOXX showing you that in the reply. Again, this was just the other day. This is a textbook downtrend. This is SOXX. This is a 60-minute chart. We're zigzagging down. You can see my arrows. I have us continuing to zigzag down, going lower. So if you're just short SOXX, you're doing very well because the shorts, came when we broke the trend lines on the off the March 30th lows. SOXX is doing great as a short trade. No problem. But because it's this is what does it. It's the more green and red. When you see this little salad, with tomatoes and lettuce, whatever you want to call it, the more green and red candles you have, that's where the leverage happens. Again, I've explained this, and I just repeat this a lot because I know there's always new traders coming to the site. Come in to go to FAQ, frequently asked questions, under resources, go to ETF related questions and click on this one right here, and it's going to explain the math, why and how that decay works. And I even go so far as to explain what I don't know if I never see anybody else talk about this. I only get negative press on these. These leverage ETFs will actually do better. Not only will you not have decay, but you'll actually do better than 200 or 300 times the return of the underlying if you can catch one of those unidirectional trends. And we've done it here quite a few times. Silver is a great example. I gave you a leveraged silver short right before it crashed, but then said, look, let's get that initial crash and then get out. And then you can either go into a silver, SLV short with no decay, remove the leverage unless your degree of confidence in a unidirectional trend. Because it's those every day that a short ETF, leverage short ETF, has a green close, or the underlying index is when the decay happens. So we've had, again, a nice, clean, pretty clear downtrend in the semis, but SOXX, that's where it kind of works against you. Even if you're positioned on the right side of the trade, this is kind of more of a sideways, so it's kind of lagged a little bit there. That's it. I mean, it's still moving up, don't get me wrong, from off that divergent low. But if things happen, if the dam breaks next week, whether it's due to the any of the big tech companies crapping out on earnings, or just an organic breakdown of that trading, that the support level that I've highlighted on QQQ, and we start to go down pretty hard, then these guys could rock and roll, and then that's when SOXX should outperform and it could shoot up quick. if that T4 level's hit, I told you I might have to tweak these over time because of the decay, but from where we're at today, let's just for kicks and giggles say that T4 is hit. That's going to be 151% return. Um, but I hate to even talk about that because I think when I point out those some people only hear 100% 150% return. They don't hear it could be a 30% loss even if it goes sideways for another few months just due to the decay, or God forbid the semis go the other way. Then you're really going to feel pain. So again, guys, you do you, but if you're not experienced, if you have to ask the question about when to be in it, when not to be, don't I cannot give individual investment advice. I can give generic investment advice. Stay away from these or use these what they were originally intended for, which are day trading only vehicles. They will tell you when you read the prospectus of these companies, they're intended for single day moves if you're trying to bet. Now, we don't do that here. I don't once in a while I'll trickle out day trade ideas to you guys, but we're swing trading. And so again, there may be a time, and it may be as soon as next week, to flip from an SOXX short to an XOSS long, the 3-time inverse. Okay, enough on that. Back to the questions. Home. Okay, that one was back there. I told you we're going to cover, go back, roll back here. I think I covered everything from over here. Let me just make sure. We're at 50 minutes into this video. Okay. Yeah, you can go catch up on the comments. I believe I went through that there. And yeah, more questions about the SOXX trade. And again, please read this reply. How what I said here about there's no one size fits all strategy exit plan, but I did share my plan when I'm in a losing trade that I'm starting to second guess, and I want to modify my trading plan. How I do it. That's all here. You can read that one. Again, that was from this post on July 21st. All right, let's rifle through the rest of the questions, comments. Yeah, I already covered McDonald's. I covered this yesterday. BMNR, nice wedge. Oh, and so yeah, on BMNR, yeah, I recognize, I fully see. Here's my chart. Bullish falling. Usually, again, my kind of chart, right? But this is going to trade. It's a crypto, what I call a crypto proxy. I have a whole watch list in my crypto proxies. I mentioned some of them in this post right here, like BMNR, Coin, COIN, Riot, Mara, Hive. They're all birds of a feather, guys, in this sector. They tend to move together. And so if Bitcoin drops, Ethereum's going to drop. If Ethereum and Riot's going to drop, and Coin's going to drop, Mara and BMNR, they're mostly all going to go down together. So either these bullish falling wedges play out, and then the MSTR trade's not going to go on to hit those targets, or those wedges fail. So just know that correlation there. And again, this subscriber was bullish on it, so there it is. There's your love. But I was clear. I have a BOD. I had 2 trend lines it's taken out. So if I'm trying to clear all the biases out of my head, where I think crypto's going, where Bitcoin's going, where Ethereum's going, at minimum from a technical perspective, 1782 is what I call the BOD, or benefit of the doubt. Because if I have multiple resistance levels in close proximity and I'm in a downtrend, I want to give it the benefit of the doubt. I don't want to take the first breakout of the first trend line. They're all coming in together, and that second trend line comes in right around that 1782. So if it breaks out, take it, set your stops, and let it run. And maybe it does this. Otherwise, recognize if it does break out and the breakout fails, then that's where appropriate stop should be placed. Okay. Okay. They went on to comment about that one. Right here, yesterday's earning predictions video. Congrats on the I guess the new summaries I'm doing. I actually love these summaries. I went there and replied there to that comment that yeah, I even find them useful myself. does a lot. I can revisit those video recaps. I go back and it prevents. I used a couple examples recently where LMT I had as a long trade, hit one or more targets, and then it fell off my radar. But if I had kept it on my radar, and it's easy now for me to go back and catch up, especially on the weekly summaries I'm doing. And oh yeah, okay, LMT pulled back to that support level and put in an even bigger divergent low, and then the stock took off, and that was right here, LMT. It was one of the recent earnings ones I went over, and so that was it. So remember, we hit it. We took it long. We hit my first target. I guess it was right there. Then it went in. It back tested the bullish falling wedge, hit that same recent support of 488 with nice big positive divergence. And again, it had fallen off my radar. That's why I highlighted the other day. But then it popped, hit my second. What I initially gave you is my second. Now my third target, and probably isn't going to stop until it hits the fourth. And that's a hard out. That's a big resistance level. That was the final target. If you happen to be in this one, that's where I would be. If I was in it, I'd be taking full profits. At bare minimum, tighten stops to let it run. But on that one, yeah, we're going to be overbought. I don't see much more coming out of past T4. So if you're there, we're almost there now. At this point, at least raise some stops to protect some of the recent gains. Had a nice run up. And then the other one I mentioned in there was Progressive. That was another long trade we had recently, which again, it didn't totally fall off my radar, but again, it hit the. We took the quick profits. I to be just kind of harvest those gains. I canceled T1 and 2, but T2 and 3, but then it was hit, pulled back, but then it's pulled back to the support. I haven't modified. These were levels were already here, and then that would have been a buy point. Hit that T1 level again. Right now, I don't have much of an opinion, but it's looking good because the zero line is being back tested. This was bullish right here when, remember, the stock had been in a bull trend all along here, based on that indicator, the PPO being below the zero line, and I guess we bought it on the breakout. No, we might have bought this one earlier down at support. I can't remember. You can reference the trade. Either way, so if it can punch through T1, it's going to take back the 200-day moving averages. It's going to turn this back up. So that one might have some promise and may head on up to some of these higher resistance levels. Okay, so I just wanted to say that thank you guys, and keep the feedback coming. This was a big plus. Reloaded. I shot you a private message. If you don't get it, let me know, because I got kind of granular. Obviously, you know tech a lot better than me. I spent 3 hours or more yesterday on going through this. Took your advice, and I'm using Whisper now. In fact, this video will be the first dry. I did a few dry runs yesterday. As soon as I'm done here, I'll try that, and it'll allow me to get these things out quicker. As soon as the video is uploaded and processed on YouTube, I'll have the transcript, a very accurate transcript, so I can then do those summaries and get them out to you guys with the videos. Remember, when I first started doing this, I had to wait. I was waiting for YouTube to process the transcript, which can take hours and usually does, and then I would follow up with the video summary. Well, now you guys are getting it as soon as I can print it. There's no way to rush YouTube's processing. When you upload a video, they're going to process it as fast as they can. It depends on the length of your video, the video quality, and how busy their servers are at the time. And as soon as it's got a presentable, meaning, sometimes I shoot them out to you. They're initially in standard definition. That's 360p. I record them in 720p. You don't need 1080 because there's no visible difference on charts. If I had a video blog and I was looking at scenes of nature and landscapes and photography, then you need videos of people. You want to use 1080 where things are very clear. I just kind of being a little techie with you guys. So the best you're gonna see on my videos are 720, because I think, if I'm not mistaken, 1080 high def is 4 times the pixel counter density. It's a much larger file, not just twice or whatever 720. I upload these. What I'm getting at, as soon as YouTube gets it processed, and there's that's when I post it out, get it out to you guys. That usually only takes 15, 20 minutes. Again, it depends on how busy their servers are at the time and how long a video I did. So now I can insert the transcription and then generate a summary of that video as well for you. Okay, so yep, if you didn't get that private message, let me know. I'll let you know how I set it up. And if you have any other, any of you, if any of you have any feedback, any improvements on how I can make the site better, anything you want, let me know and I will try to incorporate that. All right, so here's one. Somebody said a giant bull flag on the weekly question mark. So asking about that. Since the April 2025 low, this chop narrow range may turn out to be the bull flag. No one time. So anyway, I'll get to that. Here's my reply. So at the point, and this was yesterday, you have, as I covered early in the video, we had a what may have been a bullish pennant. A bull flag always has to descend like that. So we'll get to that and let me answer that question. And I acknowledged it and said, hey, it could turn to be that. And if it does, I shared how to play it. So let me turn off all the lines. Here's a weekly chart. So you would have a bull flag. As I said in that reply, a bull flag is a very close cousin to the bullish pennant. A flag just takes that downward shape like that. And it's a very simple pattern to trade and to calculate. Your measured target is the length of the flagpole, which is the entire impulsive move leading up to the top before the flag was formed. You always want to scrub it up for volume. You want to see, as the flag is formed, you want to see volume diminishing. So you want to see that consolidation, a downward consolidation on declining volume. Then the third component, it's only a potential pattern, just like a bullish falling wedge pattern is a potential setup pending a breakout. The breakout comes when you break above it. Then the measured target, depending on which source you check, some folks will add the length of the flagpole to the top of the flag. I've always liked to add it to the bottom. I've read both ways and I've used that. And from my experience, that tends to be where it is. So again, you can take it and like any trade, what happens is to say that you do pop the flag, which would be, remember that symmetrical, the downtrend line off the highs I gave you. Take it and then just set your stop if it fails. Because if you pop above it and the breakout fails, then you no longer, the whole reason for you entering that trade has now been invalidated. So you really don't have a lot of downside. So yeah, I would be a fool to say that that's not a possibility. And again, the measured target would tell you here, here's how you measure it if you want the exact number. Use a trend line. Let me do a different board. Let me find a clean board since I had this one marked up already. Here we go. I'll just use this board here. Draw a trend line, put it to the highest point, and then add it to the lowest point. Now, it hasn't broken out yet, but the symmetry right now, the flag shouldn't get much bigger. Just from my experience and looking at these patterns, you don't want a flag that's this long. It's not going to work. It needs to be, less than half the length of the flagpole. So if it's going to break out, it's going to do it soon. And maybe again, Apple, Microsoft, maybe those other big tech companies are the catalyst next week. I didn't mention it early in the video. I'll loop back to it. We have positive divergence on the 60-minute chart of QQQ, by the way, as we're testing this support we're at. But that's your measured target. So basically, you take that line. You can either drag it, or if you want to just create a parallel line to duplicate it, it's the same thing. And then that tells you your measured target right here is going to be 886.50 on QQQ, which would be, from where we're at now, in percentage terms, that would be a 30% pop. And so you will not want to ride that out short if that happens. And so again, when you go back to my reply, I said, sure, that's certainly possible. And if you're going to play it, and that's how you play it. Just recognize it. If the breakout fails, then it failed, and then it's probably not going to play out. Another question about SOXX, SOXX. Patience is a virtue. Nice pullback in SOXX today. Those are just comments. Yeah, and yeah, on this, I'm just Mo North. I'm just reading this comment for the first time. It's It's below the top of the T1 zone where we kissed a couple times, but we were at the bottom of the first target zone. And then on that, let me show you that positive divergence. If you didn't see it on my chart when I was going over it before, trust me, this is very much keeping me open-minded right now for next week. I'm always going to share what I think's going to happen if I have strong convictions where I think things are going. So I'm still maintaining these targets, favoring that. But you know me, I love me some positive divergences to go long, just like I love me some negative divergences to go short, right? That was the catalyst, the technical catalyst for this correction off the high was the big negative divergences that have been building on the daily, weekly, and monthly chart. And now we have positive divergence. The $1,000,000 question is, are these divergences going to get burned through? And they will if we break down and go down to my targets here. And again, why am I leaning that way? Well, among other things, we have the also have now a bearish crossover that's already now occurred, high level bearish PPO crossover on QQQ. I've told you before, one way to look at that is you put up a PPO histogram, and that'll show you when the PPO crosses. And you can see we've had on the weekly chart, last one was here. Total said and done was a 13% correction in the NASDAQ 100 from the previous high. We had one right here. That was the previous one. And that was, here, I'll measure it. So again, they're not, sometimes you get them, and by the time you get them, most of the moves already done. It's not a perfect indicator. There's one that you got one, there wasn't a lot of meat. But this one, there was still some meat left on the bone. And at minimum, the market, it went down, but it went mostly sideways for months. And you can go back in time and look at this indicator, and it's done a pretty good job of defining the trend. So this on the weekly chart makes me not favor this scenario, but rather that we're going to break down and go and hit those targets. Okay, video is getting long. I promise to cut to all the questions. We have one more, I believe. I think I just got all these, right? Please tell me I got this one. Yeah, I did. Okay. So the latest comments, T-Flow. I looked that up. T-Flow is a treasury that does the adjustable rate treasuries. I can't chart it because there is no chart. That's what the chart looks like. That's a weekly, that's a daily, because it's a stable asset thing, kind of like a money market fund. It's buying floating rates. I went to the site, checked it out. My apologies. I have 1,000 windows open right now. I don't know where it is. I checked the company site. Yeah, and that's all it is. It's adjustable rate treasuries. So if interest rates go up, which is my guess, remember, treasury we're flirting with, we just popped again those not multi-year. The media keeps saying multi-year when I read highs. These are multi-decade highs in the 30-year bond. The 10 years going up. I remain longer term bullish rates, which means bearish bonds. And so, yeah, rising rates, it should do well. But when you ask my opinion, I can't chart. There's no chart here. It's this quirky, this is what it comes up with, because again, you're not going to have price volatility much with a floating rate funds. You can, I don't know. So again, I'm sorry, I can't give you a much of an opinion there, other than the safest place to put cash is a money market fund. I don't know how much more T-Flow is paying, and there's probably going to be some volatility if it's using longer term. Even if they're adjustable rate treasuries, it depends on how often they adjust, like tips and all that. There's more volatility than a money market fund. So is it worth it to chase an extra 1-2% yield versus just going into brokerage money market funds? Probably the best place to wait if you're waiting for a trade setup that you like. PPC, setting up for a starter long, building bullish divergences. Absolutely. Again, you can go here, resources. I just covered it. I've been covering PPC along with the processed food companies. My last recap was just right here. Here you can go down the recap, and right here you can see consumer staples and defensive equities, and right here I covered it. Many of these have already hit their final targets, so I've been reducing positions on those that hit. But I still, a lot of them still look good. In fact, in that group, here's where the summary came up. You can go to the video and catch up to that part of the coverage. But I talked about Hain, JJSF, PPC, and SJ. Well, I talked about all of these companies. Obviously, I'm going to look at those three right now: JJSF, PPC, and SJM for you. PPC, yeah. As I said back then, I like it. You have a that one hasn't the train hasn't left the station on this like some of our other ones that already hit our final target. Nice support right there. Bullish falling wedge. It's been consolidating in this range. Needs to pop this 30-32. You're getting paid to wait. That's on a lot of these guys. I don't know this one. I'd have to check the dividend yield. It's in that packaged food sector. You can see down here. Again, this is a stock I've covered lately. There's a longer term targets, that downtrend line, 200-day moving averages, and the 3410 level. If the market craps out, it could, and it loses this support. My next support's not here to there, and then ultimately down here. So don't fall in love with it. Remember, a bear market, if we get a bear market anytime this year or next, it's going to take just about everything down with it, even a lot of consumer defensive stocks. They're just going to fall less than the broad market. So if that happens, this is where I'd love to buy this stock if it gets down here. And that's a pretty long ways down. But I can tell you right now, it's still at it's objective to buy here at or around, but not below that 2665 support. And you can add, if it pops above 30-32, it should run up to my next target. And so, yes, definitely like that one. And then what was some of the other ones I mentioned in there? JJSF also still looks good. Again, these are some of the ones that haven't, train hasn't left the station on yet that I highlighted before. Nice. You got a lot to like here if it breaks out. It's in a downtrend, but there's the trend line that needs to take. I have two trend lines, but that's the overriding one. I have also an alternative trend line there. And then you can see these 200-day moving averages coming down hard. Positive, nice positive divergence. So if it can pop that and then pop the 200 days, 87.875, it's probably going to shoot up here to 98.23. That's a total profit potential on this one, not including dividends, of about almost right about 28%. Dividend yield, if this platform is correct, is showing me it's kicking out a 4.2% dividend yield. So like the other ones that we had, you get paid to wait even if you get in this one early. And like anything else, don't fall in love. It's in a downtrend. Something's going on. It's not so good. There's my weekly chart. I'm just taking a peek. And then what was the other one? SJM. That's another one I've been covering in the same package sector, packaged food goods, package right there. This is when I first highlighted it for you right here. I highlighted the failed. I said it was bullish when it took out this support level and then recovered it. That's I called it a false breakdown bear trap. And so from that point, I'm highlighted as an objective entry, and it's you've made, if you took it, 27% so far, not including the nearly 4% dividend that it's paying. And it is coming up, by the way, to my final price target, and it's close enough now. Raise stops, don't let it get away from you. If it gets there, you're going to have some negative divergence and pretty big resistance. So we about shared all the meat off that one too. Okay, last but not like, this is more of a comment, not a question. Just talking about, I think in this comment they're talking about how this subscriber believes the markets will be range bound, rebuying individual names, and that's what we've been doing. We've been individual stock picking. No, not. I mean, we are short the indexes via those sell signals recently, but it's been a stock pickers market. And at any point, you go back and look at the trade ideas, completed trades, and scroll down, and you can just see they've been everywhere. Insurance companies, packaged food companies, crude oil, tech companies, long and short. This is all, you can view the trade categories when you go in there. You can click on completed trades to get them all. If you only want to see the long trades that we've completed this year or any year, they're all listed there as well. So you can see I'm an equal opportunity trader. So again, I may talk about the demise of Bitcoin or the crash of silver or the semis going down or a long-term outlook bearish view on the stock market or treasury bonds. But at the end of the day, that's not where I'm trading. It's not where my money is, where I think things are going to be 10, 12 years or even 5 years from now. So this shows you just the longs alone. They're all over the place, tech, packaged foods, insurance, crude oil, another blue chip stock, tech stock. And again, these are just the long side trades. And then you have just as many short trades that have been successful with the stock market near all time highs. God forbid we get a real correction or bear market. The short trades are going to just start rocking and rolling. But I'm going to always keep a mix of long and shorts. And remember, also keep a mix of this is not just about stocks, very much commodities, alternative assets, crypto, bonds. You go back far enough, you're going to see trades on treasury bonds and other things like that as well. So, all right, guys, I am going to wrap it up here. Super long video. Again, you'll have the summary. I noticed recently some of the timestamps weren't working correctly, and I'll try to get that fixed. I was able to rerun a prompt and get that working, so that way you can just jump forward to any trade or any section that you want to in these videos. And as always, keep the feedback coming and let me know if there's anything I should do different. This video went a little longer than I want. I'm going to make a point to try to start breaking these down maybe into smaller parts. But again, I think with the AI summaries, it really, really helps. You don't have to sit here and watch this hour and 15 minute long video. Okay, this has been Randy Finney with Right Side of the Chart. Have a great day.